This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of that first session, we saw our first calculation of the tax on the chargeable estate, and a very simple exercise it was, as you can see in front of you on the screen now. We were told the amount of the chargeable estate at death, some $750,000. Remember, in an exam question, that would be your listing exercise, using the valuation principle, the transfer of value principle that we know, ensuring that the relevant mortgages were deducted from the value of any property and the other relevant ones were not, i.e. we do not deduct the value, the amount of an endowment mortgage. Only repayment or interest-only mortgages there are to be deducted. We would include the proceeds of a life policy rather than the market value at the date of death. We would deduct any liabilities due at the date of death, like a credit card bill. We're also allowed to deduct what we call loosely reasonable funeral expenses, but we would not be deducting any liabilities that were not legally enforceable. The classic one for exam purposes that the deceased had said prior to death that he would help somebody out making a payment for some bill, like a hospital bill or whatever, that would be paid. Again, that is not a legally enforceable debt. Whether, again, those beneficiaries choose to use some of their money to pay that off on behalf of that individual, that's down to them. But for tax purposes, it's not an allowable deduction. We would also take out any exempt bequests, i.e. to a spouse or civil partner, and having got the chargeable estate, then establish the amount of the available nil rate band. What will be the nil rate band in force at the date of death, and has been for a while, £325,000. The only thing that could have used up any of that nil rate band already would be the lifetime transfers that had occurred within the 7 years before the date of death. Now, in that previous example with poor D there, departed, who was killed off on the 1st of February 17, she had made no such transfers during her lifetime, so the full 325 nil rate band was available to go against the value of her estate at death, leaving only the balance of 425 to be taxed at 40%. Well, what we'll see now in illustration 3, as we pick it up from where we had left off last time, what about now if, in addition to what you see in illustration 2, D had also made a lifetime chargeable transfer of value of some £200,000 in June 2014, very clearly, therefore, within the 7 years before the date of death. What would happen now in computing the IHT liability as a result of D's death? Ever so simple. All we do is to still compute what was the chargeable estate at death. That would still be £750,000. We then establish what was the available nil rate band, and this time the available nil rate band would not be the full $325,000, because the first $200,000 of that would have been used to reduce that lifetime chargeable transfer of value down to 0, meaning that no tax was payable on it. So, as the chargeable transfer made falls within the 7 years before the date of death, it will become chargeable as a result of D's death. It will, however, good news for the recipient, fall within the nil rate band of $325,000 in force at the date of death, so there'll be no IHT payable thereon. But it will mean that only $125,000 of the nil rate band will now be available. We've used 200 out of 325, leaving 125. What is that going to do now in terms of a chargeable estate at death? Well, if there's only 125 of nil rate band, that's pushing an extra 200,000 of the chargeable estate out of the nil rate band and up into the 40% band. So instead, therefore, of only 425,000 of that estate being taxed at 40%, we've now got £625,000 being taxed at 40%. So instead of £170,000 of tax, you may recall, that now has gone up to £250,000. We can see that the amount of tax that becomes payable in relation to the death of the taxpayer is all to do with what the donor has done during their lifetime. Very specifically, here within the 7 years before the date of death. So this is a cumulative donor-based tax, an expression that we'll use a lot of times here in trying to explain how it is that IHT works. Well, although it may well end up with the donee having to pay any tax on any lifetime transfer, because the donor now is dead, it's not them that's going to pay it. It will be the donee who becomes liable for any tax on a lifetime transfer. The amount of that tax is nothing to do with the circumstances of the donee. It's everything to do with the donor. This is a cumulative donor-based tax, which we will illustrate some more when we move on to later illustrations. But just one other point, and a very important point it is too, very important practical point in terms of IHT. If now, in that illustration 2 that we've seen, if D had been described as a widow. Now, she was a spinster, had never been married, there was no spouse. But if now she is a widow, then there was previously a spouse, and that she had received all of her husband's estate on his earlier death, and he had made no lifetime gifts. Then that would mean that the husband would have made no chargeable transfers, as transfers between spouses are exempt. So he would have used none of his nil rate band, meaning that 100% of his nil rate band would have been unused. And only ever since the late 2000s, when this really fundamental important change came in, it means now when what was D, the surviving spouse, when D then dies, a claim may be made for the unused proportion, here 100%, of the husband's nil rate band to transfer to D. So that when we then compute the tax on D's death, the nil rate band will now be her own 325,000, she had made no lifetime transfers, plus 100% unused from husband. That's 100% times the current, her now available nil rate band. She gets effectively 200% of the current nil rate band, which at 325 would mean she ends up with £650,000 worth of nil rate band. So that would allow an additional amount of tax of £130,000 to be saved. We've now got an extra £325,000 of D's estate that will now not be chargeable to 40% tax, so that's going to save £130,000. Note, as we've just said, that irrespective of the level of the nil rate band that existed at the date of her husband's death, D will now benefit from an extra 100% of the available nil rate band when she dies. So if back when husband died, the nil rate band had back then, for example, been 300,000 rather than the current 325, D would still get this 650,000 being 200% of the current 325,000 nil rate band. It would not be the husband's value, the amount of his unused nil rate band, 300,000, plus the current nil rate band, 325, totaling 625. No, it is better than that. We work out on the death of the first spouse what is the percentage, the proportion of the nil rate band that is unused on that first death, and it is that proportion that is transferred then to surviving spouse, so that when he or she then dies, we can add in to their available nil rate band the relevant percentage of whatever is then the nil rate band at that date. Very good news indeed. Now again, that was a fundamental change that occurred towards the end of the 2000s, and probably still the most important bit of IHT legislation ever since its introduction. All you've got to do is pick it up and use it. Lifetime transfers are therefore to be denoted as one of three different types. They could be exempt transfers, meaning they're not chargeable when made, they are not chargeable on death. Whenever the subsequent death occurs, they are exempt. What were they? Transfers to spouses or civil partners. They could be chargeable lifetime transfers. They, remember, were transfers into trusts. You've made a lifetime transfer into a trust, and what that means is we don't just wait around to see whether the taxpayer dies within 7 years of the date of that transfer, but we'll actually charge it there and then in lifetime, but using specific lifetime rates. That's not difficult, and it's given to you on your rates and allowances page, but it's the gross rate in lifetime is half of the rate on death. The rate on death is 40% above the nil rate band. Well, it's 20% as a gross rate in relation to the transfers in lifetime into trusts. And then the third and final category, which of course will incorporate the vast majority of transfers made by the taxpayer in their lifetime, and that will be pets there. They will be pets, potentially exempt transfers. These are pets. Now, that, as I said, is the vast majority of transfers made in lifetime. And it is those pets that we now go on to discuss in more detail. So, just before we do that, go back through the examples we've just done and make sure that you're happy with them. So we'll pause for a moment before then dealing with a specific note on pets. Okay, so let's look at these pets, therefore. And again, a very descriptive name. When made, there is no IHT. So a pet is a lifetime gift made by one individual to another, other than to your spouse or civil partner. And the fact is that when the transfer is made, there is no IHT liability at the date of the gift, because at that point they are potentially exempt. What would make that transfer to be exempt? Well, if you survive for 7 years. When the pet is made, the original assumption is that the gift will be exempt from IHT. You, the donor, certainly hope that will be the case, because if it does become chargeable, it means you're dead, and you're dead within 7 years of having made it. So if the donor survives for more than 7 years from the date we made the gift, the pet for which there was no IHT liability at the date of the gift will become fully exempt. What was potentially exempt when made becomes fully exempt if the donor survives for the requisite 7 years. And that means that it will be ignored for IHT purposes, other than, we've not yet seen them, but if you had a list of transfers within a year, it may still use up an annual exemption, but we'll see that in a later note. At the moment, we are assuming that what is the transfer of value is also, another term I've used, the chargeable transfer. We'll discover that that is not necessarily the case, that there are certain exemptions, notably an annual exemption, available to the taxpayer each year that may be deducted from a transfer of value to derive the chargeable transfer. Going on to the computations that we are now seeing will indeed be those chargeable transfer figures. So, what happens if the donor dies within 7 years of making the gift? Well, then that pet will indeed become chargeable on the death of the donor. IHT, then, as we know, would be payable at 40% on the value of that gift, less, of course, any available nil rate band. Now, in that previous illustration 3 that we had, we saw that in that situation, their only lifetime transfer that occurred was a potentially exempt transfer, but it was only £200,000. And that meant that it was fully consumed by the available nil rate band of 325. so there was no tax to pay. But if those lifetime transfers, those pets made within the 7 years of death, exceed the available nil rate band, the nil rate band of 325, then anything going above that 325,000, or indeed up to 650,000, if the surviving spouse has the previously deceased spouse's unused nil rate band to enjoy as well, that anything above the nil rate band would then be taxed at 40%. If the taxpayer did survive not for 7, hence it's become chargeable, but for at least 3 years, then something else comes into play. If we survive from the date of the gift more than 3 years, any IHT is reduced by the available taper relief. We'll see this in Note 5. Any IHT payable on the pet is paid by the donee. Now, when we look therefore at these pets and the relevant date of the death of the taxpayer, we're interested now in 2 periods of time. For the pet to be chargeable, it must fall within the 7 years before the date of death. If it is more than 7 years from the date of death, what was potentially exempt when made has become exempt, and that's it. If we died within 7 years of making the pet, then it will become chargeable on death. And if that pet takes us above our cumulative available nil rate band, we'll presume the single figure of 325,000 for the moment. If we go above 325, tax is payable at 40%, rather than just at a nil rate there. It's a 40% charge that would become payable. But if you survive for more than 3 years, then any such tax charge will be eligible for a deduction known as taper relief. Where more than one pet has occurred within the 7 years before death, then the nil rate band, as you'd logically think it to be, would be applied strictly on a chronological base. The earliest transfers benefit first from that nil rate band, as we'll now illustrate with illustration 5. As per illustration 3, where we had one lifetime transfer of 200,000, we're now told that D had made 2 chargeable transfers in her lifetime of £200,000 each. The first in June 14 and the second in August 14. Now we'll remember that, of course, when did we kill off young D? We killed her off. The date of death was the 1st of February 2017. The 1st of February 2017. What we've now done is to ensure that each of these 2 transfers, June 14 and August 14, fall within the 7 years of that date. Going back 7 years from that date would be back to the 1st of February 2010. Yeah, June 14, August 14 are both within that 7-year period, so these become chargeable. If and only if any tax is payable on either of them, would then taper relief become available if the transfer was more than 3 years before the date of death. Now look at the dates that I've given you. The earliest was June 14. 3 years on from June 14 would be June 17. Sadly, our taxpayer D did not survive until June 17. As we know, she sadly died on the 1st of February 17, which means that any tax that we now compute in relation to either of these transfers will be fully chargeable. We'll have no deduction, no taper relief available. How taper relief, of course, works, we'll see in a later example in just a few minutes' time. So, D has made pets within the 7 years of the date of death. These now become chargeable along with the chargeable estate, and IHT is to be computed as follows. This working separate computation, as we saw in the previous example, headed up lifetime transfers chargeable on death. But now the chargeability is not all going to be at nil rate. But we go back 7 years from the date of death. The date of death, remember, the 1st of February 17. Back 7 years, that would be to February 2010, and then come forward and list out the first transfer made in that 7-year period. Well, it, as we know, was June 14. It was a pet. The gross amount of that transfer was 200,000. That is less than 325, so it's all covered by the nil rate band. There is no tax. On to August 14. Remember that expression? It is a cumulative donor-based tax. So we've already used up 200,000 of our available 325 nil rate band, meaning that only £125,000 of nil rate band is available to go against this transfer. What does it therefore do? It pushes £75,000 now of this pet of 200,000 in August 14. It's pushed out of the nil rate band and up into the 40% band. So 75,000 at 40% is £30,000. There is our tax charge. That £30,000 liability will be paid by the donee of the gift. And as we've said, there is no taper relief to go against that 30,000, no reduction for taper relief, because we haven't survived for the requisite 3 years prior to that date of death. We have survived for less than 3 years. August 14 would have had to have survived until August 2017 to have benefited from any taper relief. Sadly, it didn't happen. As we know, we killed young D off on the 1st of February 17. So the 30,000 liability will be payable, and will be payable by the donee of the gift. So although the donee pays, the amount of tax payable by the donee is nothing to do with them and everything to do with the donor. It's a cumulative donor-based tax. Look at what we've got within the space of just a few months, June 14 to August 14. We have made two amounts of transfer, both gross transfers of 200,000. They're both the same. So each individual beneficiary was benefiting from the gross transfer of 200,000. But then when the donor dies within 7 years of having made them, the June 14 transfer, benefits in full from the nil rate band. So that particular beneficiary, that individual, will pay no tax, irrespective of the fact of whether or not the donor dies within 7 years or survives for more than 7 years. There will be no tax to pay. But the second, same transfer, £200,000, it is merely the timing that is different. It has come second, not first. That has left 75,000 of that transfer out of the nil rate band and pushed up into the 40% band. So that donee will have to pay £30,000. As we've said, as the August 14 pet is less than 3 years from the date of death, there is no taper relief available to reduce that tax charge. Taper relief was irrelevant on that first transfer. Why? Because there was no tax to reduce anyway. Taper relief is a tax credit relief. It reduces the tax charge. It does not reduce what is chargeable to tax. It reduces the tax charge itself. There is only a tax charge on the August 14 transfer. Sadly, taper relief won't be available because, as we said, didn't survive for the required 3 years. As the nil rate band, as we've said, has been fully used on the lifetime transfers, then the entire chargeable estate of 750 is now, it's all pushed out of the nil rate band and up into the 40% band, giving therefore a further liability of 300,000. 40% of 750 is 300,000, this time to be paid by the personal representatives. So any tax payable on pets is both paid by and borne by the individual donee. Whereas, where we started with all of this, any tax that is payable on the chargeable estate at death is payable by the personal representatives stroke executors there, but that money is paid out of the deceased's estate, meaning that, should there be such a person, it is the residuary legatee that bears the cost of that tax. From what we've just seen, and to take us through to our next simple scenario, it can be seen that if the taxpayer survives for more than 7 years from the date of the pet, then that pet will be both exempt in its own right and, in addition, will have no effect on the chargeability of either those lifetime transfers falling within the 7 years before death or on the chargeable estate itself. So if it's more than 7 years before the date of death, what was potentially exempt when made becomes exempt on death. It is not taxable, nor will it affect any tax on those transfers that do fall within the 7 years before the date of death and therefore are chargeable. Yep, this is a cumulative donor-based tax, but when we're looking at the pets, we're only interested in those that fell in the 7 years before the date of death. Just to make sure we've understood that point, if we now say that in the illustrations 3 and 5 that we've been working with the numbers of, that there had been an earlier pet of £200,000, it being 8 years before the date of death, then that would be exempt and would have no effect on the amount of IHT payable on either of the later pets or on the chargeable estate. So even though at 8 years before the date of death, the two pets that were when made in 2014, the 8 year ago pet would be within 7 years of those particular transfers, their tax would be unaffected by the existence of this earlier pet. So we only put into our computations those transfers made, those pets made within the 7 years before the date of death. We mentioned there a moment ago taper relief, relevant if when a pet becomes chargeable, because we had died within 7 years of the date of the transfer. Although that happened, we did survive for at least 3 years from the date of the transfer. And that gives rise to a reduction in the tax charge. And it works on a sliding scale, moving in 20 percentage points, such that if we only manage to survive between 3 to 4 years from the date of the transfer to the date of death, the tax charge, if there is one, is reduced by 20% taper relief. Through to, if you very nearly made it to 7 years and therefore would have avoided any and all tax charge arising, then we'll get an 80% taper relief reduction in that tax charge if there is one. And in between, we get the movement, as we said, in 20 percentage points. Survive between 4 to 5 years, 40% reduction. Survive for 6 years, a 60% reduction for taper relief. Illustrated now in illustration 7, we'll have same as illustration 5, but this time those two lifetime transfers, instead of both being in 2014, June and August 14, will now redate, the earliest one at January 2011 and the second one at June 2013. Both of those now, though within the 7 years of the date of death, are again also more than 3 years from the date of death. So again, we set up our computation of lifetime transfers chargeable on death with a date of death the 1st of December 17. And that computation may be set up. 2 columns required for it to record the gross amount of transfers and the IHT, if any, thereon. Back 7 years from the 1st of December 17, oh, 1st of December, that's not right, from the 1st of February, I think it was, 17, let me just change that. My apologies. From the 1st of February 17 there. Back 7 years would be to the 1st of February 2010. come forward from that date. Yep, there is a pet January 11. Remember, any pets before the 1st of February 17 are to be ignored. January 11 pet, £200,000. So again, all of it consumed by the available nil rate band, so no tax to pay. On to the second £200,000 going in there. We've already got 200,000 of the nil rate band used. That means only 125,000 left, pushing 75,000 up into the 40% band, a figure of tax, as we know, to be £30,000 there. But this time, the date being June 13, we have survived for more than 3 years. To be precise, between 3 to 4 years. 4 years on from June 13 would have been June 17. Didn't survive until then, died in February 17. 3 years on from June 13 would be June 16. So yeah, we survived for between 3 to 4 years. So that means, reading from the table, that table will be provided for you in the exam, though I suspect you shouldn't have to refer to it. You should know it by then. It's a simple enough table. The pet falls between 3 to 4 years from the date of death. The tax charge is reduced by the taper relief of 20%. The tax charge, that 30,000, is reduced by 20%. 20% of 30,000 is 6,000. Apply, please, the taper relief to the tax charge. Don't go and reduce the £200,000 gross transfer. It's the tax that is reduced. As in illustration 5, the nil rate band has been fully utilised now on the lifetime transfers that fell within the 7 years before death. So the entire chargeable estate of £750 will be taxed at 40%, giving a liability of £300,000. The difference this time, from this example to the previous one, is that £6,000 taper relief is now available to reduce the £30,000 tax charge. Okay. Have a little think, therefore, now about how we deal with pets and about the cumulative nature of this tax. Knowing that on death, there having been no tax in lifetime, we are only concerned with pets made within the 7 years before the date of death, and they use up the nil rate band on a first come, first served basis, on a chronological basis. But then, the first pet that moves you out of the nil rate band and up into 40%, the excess above the nil rate band is at 40%. If that transfer is more than 3, but of course less than 7 years from the date of the death of the taxpayer, then any such tax charge would be reduced by the available taper relief. In this example, 20%. 20% of 30,000 gave us 6,000, leaving a balance of £24,000 to pay. As we said, it can now be seen that the amount of tax that arises on either transfers made in lifetime or on death cannot be computed in isolation and is nothing to do with the circumstances of the donee or donees. IHT is a cumulative donor-based tax. Think on that, go back through those exercises please, make sure that you're happy with them, and then we'll move on to look at the third and final type of transfer you might have to look at in lifetime: transfers into trusts, otherwise known as chargeable lifetime transfers. We look forward to telling you all about those in our next session together.